Today we're going to talk about spread trading. Our spread trading has been doing well lately during market corrections and volatile markets, so it's a good strategy to employ in really any type of market, but especially non-trending volatile markets like we've had recently. Now, the spread strategies we're going to look at today can profit if the underlying stock is up, flat, or down, and they're ideal for navigating volatile markets. We're going to look at a simple strategy that helps us lock in profits for our stock and option trade. So if we have a directional stock trade or a directional option trade, we always like to leg into a spread to help protect profits. And when you do that, you can hold on to the position during market corrections and volatile markets a lot better than you can compared to directional trades, because with directional trades it's easy to get stopped out when the market gets volatile. So we set up these spread trades that help us maintain the positions and profit through volatile markets. So we're going to look at three types of spreads today. We're going to look at profit guard option spreads, profit guard stock spreads, and covered calls. And all three of these types of spreads are limited risk spreads, which means you can't lose more money than you invest. And I'm going to show you a recent brokerage snapshot that has these spreads in the portfolio, and we had a $901,000 open trade profit when I took the snapshot, an average return of 48%. So we'll go into this in detail here in a few minutes, but this just shows that these spread trades are doing well in recent market conditions. Now, spread trades have a big advantage over directional stock and option trades. As I mentioned, these spread trades can profit if the underlying stock is up, down, or flat at option expiration. Now, if you take a directional stock trade, it requires the stock to increase in price to profit. And if you take a directional call option trade, it requires the underlying stock to close at or above the strike price at expiration in order for the call option trade to profit. And just remember, if you purchase an at the money or out of the money call and the underlying stock closes flat at expiration, that will result in a 100% loss for the option trade. So these spread trades can help you avoid 100% losing trades. And during the recent correction, if you had a typical portfolio of call options, they can get hit pretty hard, like during this recent correction that we just had, and you can get stopped out on a lot of your trades and even incur 100% loss. So we try to avoid those 100% losing trades, which can really damage your portfolio. So the spread trading will increase the percentage of winning trades. If the spread trade can profit, if the underlying stock is up, down, or flat at option expiration, that will result in a higher percentage of winning trades compared to directional trades, and this higher accuracy can make you a better trader. Now, we're going to look at profit guard spreads here shortly, and they can often guarantee a profit for your option trade regardless of the price movement of the underlying stock. So there's two ways to initiate spread trades. The spread can be initiated simultaneously by entering both the long and the short side of the spread, or if you have a profitable directional stock or option trade, you can leg into the short side of the spread at a later date. So we use both type of entries when we're initiating spread trades. Now we use what we call the power trend system for selecting directional trades, and we covered power trend trade selection in our previous webinar, so I won't go into detail with power trend today, but the power trend system for selecting directional option trades has 3 steps. First, we determine the price trend of the stock using the 10-month simple moving average. Then we select an entry point using the Keltner channels. And then the last step is we use the 1% rule to select a call option strike price that will have a higher percentage of winning trades. So those are the 3 steps we use to set up a directional option trade. And once we enter a directional option trade, we use our trade management guidelines to manage that option trade. So if we have a directional trade, we want to use these trade management guidelines, and we simply will exit losing trades quickly by using a 20 to 30% stop loss from the entry price for an option trade, and we don't want to exit trades with a small profit. And another money management rule we have is if you have a 20 to 30% or higher profit on a directional option trade, then you want to leg into a profit guard spread or a debit spread to help protect your profit. Now we normally leg into profit guard spreads for stocks that have low option premiums, and we leg into debit spreads for stocks with rich option premiums. With debit spreads, you're selling option premiums, so you want to initiate debit spreads on stocks that have rich option premiums, because you'll collect more premium when you're short the premium, because the time value portion of the option, it goes to 0 at option expiration. So now one way to measure the option premium is to simply look at the time value portion of the option, and that determines whether the option premium is a low cost or a high cost. And for example, the Facebook option with 1 month till expiration, that has a time value premium of 4% of the stock price. So we would consider that a rich option premium because the time value portion of that option is 4% of the stock price on a 1 month call. And the utilities ETF has a lot lower volatility. So the time value portion of the utilities ETF with 1 month till expiration is about 1.3% of the ETF price. So we would consider that a low option premium. So with the utilities ETF, we would set up a profit guard spread as opposed to a Facebook directional trade. If we had Facebook, we'd want to set up a debit spread because we'll be selling that option premium. And for our stock directional trades, we want to exit losing stock trades quickly by using a 7 to 10% stop loss from the entry price. We don't want to exit trades with a small profit. And if we have a 10 to 15% or higher profit on a stock trade, then we'll leg into a covered call or a profit guard spread. And again, with the profit guard spreads, we want to leg into a stock that has a low option premium because we'll be buying the put option, and the lower the premium, the better. And if it has rich premiums, if the stock has rich premiums, then we'll leg into covered calls for stocks because we'll be selling that option premium. So let's talk about the first spread strategy, the profit guard option spread strategy. And as we just mentioned, if we have a 20 to 30% or higher profit on an option trade, then we'll leg into a profit guard spread to help protect our profits. And if you have a profit in a call option trade and you leg into a profit guard spread, you would do that by purchasing an at-the-money put option. So if we purchase a call option and we have a directional trade, we use our money management guidelines. If we develop a profit in that trade, then at a later date we can leg into a profit guard spread by purchasing an at-the-money put option. And of course the put options profit as the price of the underlying stock declines. And if you have a winning call option trade, purchasing that put option provides a profit guard that can help protect you against loss for your call option investment in the event that the underlying stock declines in price. Now at the same time, purchasing that put option does not limit the upside profit potential for your call option purchase if the underlying stock continues to increase in price. So if by purchasing that put option, you still have the upside profit potential if the call option keeps increasing in price. There's no limit on that profit potential by purchasing a put option. And as you'll see shortly, purchasing this put option insurance can even guarantee that you'll be successful on your option trade, and we'll show you some examples of that. So purchasing that put option to protect profits, that transforms option investing from one of the riskiest investments to one of the lower risk investments. Now once you buy that put option profit guard for your call option investment, you can forget about that option trade. You don't have to do anything until option expiration. There's no need to monitor the markets or world events. You don't have to set a protective stop. Bad earnings reports don't matter. A severe sell-off in the markets doesn't matter. And a severe sell-off can actually produce windfall profits with the profit guard option strategy. No need to worry about placing protective stops. So once you purchase that put option, there's nothing left to do until option expiration. So this is the lowest risk way to invest in options that we've been able to find. Now, because a profit guard spread has a long position, which is the call option, and it has a short position, which is the put option, this strategy is also known as a market neutral spread. And market neutral spreads can profit if the price of the underlying stock goes up or down. And as we mentioned, there's no limit on the profit potential of the spread if the underlying stock continues to increase in price. And a sharp decline in the price of the underlying stock can actually result in a windfall profit. And your risk is limited to the cost of the spread. With profit guard spreads, you can start out small with a $5,000 trading account. We normally go out 1 to 3 months on a profit guard spread trade.